Welcome to Protecting Your Portfolio, Navigating Geopolitical Risks in a Volatile Market. In today's complex world, understanding geopolitical risks is more crucial than ever for investors. First, let's define geopolitical risk and why it's a growing concern for 2025. Geopolitical risk encompasses the potential impact of political decisions, conflicts, and events on international relations and global economies. In 2025, we're seeing an alarming rise in conflicts, trade wars, and shifting global alliances. Investors are facing unprecedented uncertainty from ongoing wars, pivotal elections, and the increasing use of sanctions as a foreign policy tool. These elements create a challenging landscape for financial planning. Geopolitics is now directly tied to fundamental economic indicators like inflation, energy security, and global growth. Understanding these connections is vital for making informed investment decisions. Next, let's explore how these geopolitical risks manifest in financial markets. Geopolitical events directly trigger market volatility, causing rapid and unpredictable price swings across various asset classes. They also disrupt global supply chains, leading to shortages and delays. These events often contribute to inflationary pressures, as the cost of goods and services rises due to supply constraints and increased demand. The immediate reaction to geopolitical shocks is often a spike in market volatility, with the VIX index, or fear gauge, serving as a key barometer for investor anxiety. During periods of heightened geopolitical tension, we frequently observe capital flight from riskier emerging markets towards more stable and developed safe havens, impacting global capital flows. Supply chain disruptions are a direct consequence, impacting everything from commodity prices to manufacturing output. This can lead to increased costs and reduced availability of goods. These disruptions, especially in critical sectors like oil, gas, and food, contribute significantly to inflationary pressures and price shocks, directly affecting consumer purchasing power. Geopolitics also drive significant foreign exchange volatility, with currencies like the Russian ruble, Chinese yuan, and the euro often experiencing rapid fluctuations tied to political developments. Now let's look at effective diversification strategies to navigate these risks. Diversification isn't just about different asset classes. It's crucial to diversify geographically and by political risk exposure to reduce concentrated risk in your portfolio. Safe haven assets like gold, the US dollar, and US Treasuries play a vital role as hedges during periods of geopolitical uncertainty, often appreciating when other assets decline. Implementing robust geographic diversification helps spread your investments across different economies, reducing the impact of adverse events in any single region. It's equally important to consciously avoid overexposure to countries or regions with a history of high political instability or significant geopolitical tensions. While caution is advised, selectively investing in frontier and emerging markets can still offer growth opportunities, provided careful risk assessment and management are in place. Gold serves as a historical hedge against uncertainty. The US dollar maintains its status as a global reserve currency, and US Treasuries offer stability and liquidity during market downturns. Increasingly, some cryptocurrencies, particularly Bitcoin, are gaining a partial role as a, quote, digital hedge, offering an alternative store of value outside traditional financial systems during crises. Let's delve into defensive sectors that offer stability during turbulent times. Sectors like healthcare, utilities, and consumer staples are considered defensive because their demand remains relatively stable regardless of economic cycles or geopolitical events. Beyond defense, there are opportunities to capitalize on during periods of conflict. Healthcare, for instance, exhibits stable demand due to its essential nature, providing a resilient foundation for portfolios even when other sectors face headwinds. Utilities, being often government-backed and providing essential services like electricity and water, offer consistent dividends and relative stability in uncertain times. Consumer staples, encompassing everyday necessities such as food, beverages, and household products, see continued demand, making them a reliable choice for defensive positioning. Conversely, the defense sector often sees growing budgets and increased investment amidst rising global conflict risks, presenting a unique investment opportunity. The energy sector, including traditional oil and gas, as well as renewables and nuclear energy, can also offer significant opportunities, particularly during periods of geopolitical instability. Cybersecurity becomes increasingly critical as digital warfare and espionage become mainstream, driving demand for robust security solutions and presenting growth opportunities for relevant companies. Now let's look at broader strategic approaches to manage geopolitical risk. For timing-sensitive investors, a wait-and-see approach, characterized by patience and careful observation, can be a prudent strategy, avoiding hasty decisions during volatile periods. Building supply chain resilience through strategies like friendshoring and nearshoring helps mitigate disruptions by diversifying sourcing and bringing production closer to home. Maintaining a long-term perspective is crucial to avoid panic-driven exits during short-term market downturns. History shows that markets often recover from geopolitical shocks over time. Regular portfolio rebalancing towards more resilient assets ensures your investments remain aligned with your risk tolerance and strategic objectives, especially during shifting geopolitical landscapes. Beyond geographical diversification, actual supply chain resilience means proactive diversification of sourcing, implementing, friendshoring with allied nations, and nearshoring production for reduced transit times and risks. Integrating environmental, social, and governance, or ESG factors, and focusing on companies with proven resilience to external shocks can enhance your portfolio's long-term stability and ethical alignment. Finally, let's explore more advanced tools for portfolio protection. Using strategic hedges with financial instruments like options and futures can help mitigate specific risks, offering a precise way to protect against adverse market movements. Private markets, including private equity and private credit, can offer diversification and resilience by operating outside the immediate volatility of public markets, providing alternative investment avenues. To conclude, let's recap and address an important disclaimer. Remember to diversify geographically, utilize safe haven assets, and consider defensive sector investments to protect your portfolio during volatile times. Please remember, this video provides general educational information and is not financial advice. Consult a qualified financial advisor for personalized guidance tailored to your specific circumstances and financial goals.